Hello and welcome. Today, we're going to pull back the curtain on a financial tool that's an absolute game changer for businesses of all sizes, receivables finance. We're going to explore how companies can thrive even when they're waiting for their customers to pay up. We'll demystify this whole process step by step. So let's start with a question that seems like a total paradox. How can a business be making a profit, selling tons of product, but still find itself with no cash in the bank? It's a situation that catches so many entrepreneurs off guard. The answer isn't about profit, it's about timing. And it's that gap in timing that we're here to talk about today. All right, here's our roadmap for this explainer. We'll start by looking at what we call the business cash squeeze. Then we'll get to the good part, how to unlock your invoices. After that, we'll check out the different tools in the toolkit. And finally, we'll see how modern technology makes it all work smarter and safer. Now, to make all of this really click, we're not just going to talk about theory. We're going to follow the journey of a small company called Speedy Wheels Bicycles. Their story is going to show us exactly how these ideas work in the real world. Okay, first things first. Let's dig into the core problem itself, the business cash squeeze. This is all about that painful, anxious waiting period between doing the work and actually seeing the money for it. To understand the squeeze, you first need to understand this term, liquidity. The definition here says it's the lifeblood of a business, and that is the perfect way to think about it. This isn't profit on a spreadsheet. This is the actual spendable cash you have right now to pay your staff, buy materials, and keep the lights on. If that lifeblood runs out, the business stops. Simple as that. Now, that idea of liquidity is directly tied to cash flow. It's pretty simple. It's just the rhythm of money coming into your business and money going out. Obviously, you want more cash coming in than going out. But the trouble starts when that rhythm gets disrupted, when a whole lot of cash has to go out long before any new cash comes back in. And that disruption, that lag, creates what's called the funding gap. This is the official term for that nerve-wracking period between paying your own bills and getting paid by your customers. For our friends at Speedy Wheels, they have to pay for steel and tires today. But the big retailer they sell to, they might have 60-day payment terms. That 2-month window is the funding gap, and that's where all their cash just seems to disappear. Let's look at this on a timeline. On day 1, cash goes out the door. Speedy Wheels pays its suppliers for parts. Then, for the next 59 days, nothing. The cash is just gone. It's tied up in the value of the bicycles they've already built and shipped. It's not until day 60, 2 months later, that cash finally comes back in when their customer pays the invoice. Trying to run a business inside that gap is what keeps owners up at night. So, what's the solution? How do businesses like Speedy Wheels survive that gap? Well, they do it by unlocking the cash that's already theirs. The cash that's just sitting there, trapped in their unpaid invoices. This is where receivables finance becomes the bridge that gets them from day 1 to day 60 without breaking a sweat. The process is actually beautifully simple. Here it is in 3 steps. First, Speedy Wheels makes a big sale and issues an invoice for, let's say, $100,000. They've earned that money. Second, instead of waiting 60 days, they sell that invoice, that future payment, to a finance company. And third, the finance company gives them the cash right away, minus a small fee. Just like that, the wait is over. So what does that look like? Well, on day 2, instead of just having a piece of paper that says they're owed $100,000, Speedy Wheels now has $95,000 of cold hard cash in their bank account. That $5,000 difference, that's the fee they pay the finance provider for giving them the cash immediately and for taking on the job of waiting for that 60-day payment. It's a price well worth paying to get your money now. The difference this makes is just night and day. Before, Speedy Wheels is stuck. They're waiting for money, unable to buy more parts, maybe even having to turn down new orders. But after? With 95% of their cash in hand today, they can immediately say yes to the next big order. They can hire more people. They can grow. Okay, so we get the basic idea. But receivables finance isn't just one single product. It's more like a toolkit with a few different options, each designed for a slightly different situation. So let's open up that toolkit and see what's inside. First up, we have receivables discounting. This is the exact example we just saw with Speedy Wheels. A business sells an invoice, or a bundle of invoices, to a finance provider. It's a simple, clean transaction. The whole point is to sell a future payment to get cash right now. Next in the toolkit is something called factoring. Now, this is really similar to discounting, but it comes with a huge added bonus. With factoring, the finance company doesn't just advance you the cash, they can also take over managing and collecting the payment from your customer. For a small business owner who'd rather be making bikes than chasing invoices, this can be a lifesaver. Then there's this really cool version called payables finance, which is sometimes known as reverse factoring. Here, the whole thing is flipped on its head. The program isn't started by the small supplier, it's set up by their big, powerful buyer. A huge corporation can set up a program that allows all of its smaller suppliers, like Speedy Wheels, to get paid early. Because the risk is based on the big company's great credit, the fees are usually even lower. It's a total win-win that makes the whole supply chain healthy. So these are incredibly powerful tools. But as with any financial product, there are risks involved that need to be managed. And that brings us to our final section, how technology is stepping in to make the entire process smarter and a whole lot safer for everybody. From the perspective of the finance company, they're looking at a few key risks. First, what if the end customer just doesn't pay their bill? That's credit risk. Second, how do they know the invoice is even real? That's invoice validity. And third, they need to prevent a fraudulent company from trying to sell the same invoice to two different lenders. That's called double financing. And this is exactly where technology comes to the rescue. Digital records from accounting software create a clear, verifiable trail. E-invoicing platforms automate and secure the whole process, proving an invoice is legitimate. All this data gives finance providers better visibility, which helps them manage risk and sniff out fraud like double financing. It makes the entire system more transparent, efficient, and secure. So when you put it all together, what's the big takeaway? I think this quote says it best. Receivables finance is not a loan. You're not taking on new debt. It simply acts like a bridge. It lets you convert an asset you already own, that future payment, into the immediate cash your business needs to survive and thrive. And that leaves us with one final important question to think about. If you were running a business and you could get paid for all your hard work tomorrow instead of in 2 or 3 months, what would that change for you? What new doors would that open? What new opportunities could you finally chase? And on that thought, that's our explainer on receivables finance. We really hope this made the concept clear and showed you how businesses can transform their cash flow. We would love to hear your answer to that last question in the comments below. What opportunity would immediate cash unlock for you? If you found this helpful, a like and a subscription would mean the world to us. Thanks so much for watching.